Hello, welcome to Capital Sensei. Today we're diving deep into a book that is legendary among serious investors, but often misunderstood by the public. We're talking about The Alchemy of Finance by George Soros. We'll unpack his core philosophy of reflexivity, see how it demolishes the traditional idea of efficient markets, and explore how Soros used this unique worldview to make billions, including his famous bet against the Bank of England. And as we explore these complex ideas, remember that we always try to answer questions in the comments section. So, if anything sparks a question, or if you have your own experiences with the wild nature of markets, share them down below. Your insights and stories help everyone learn and build a smarter community. All right, let's get into it. When you hear the name George Soros, you probably think of a billionaire investor, maybe a political figure. The man who broke the Bank of England. But before all of that, Soros was a student of philosophy under the great Karl Popper in London. This isn't just a random piece of trivia. It is the absolute key to understanding how his mind works. His entire investment framework isn't built on spreadsheets and earnings models, but on a philosophical idea about how reality itself functions. The book isn't a how-to guide with 7 easy steps to stock market riches. Frankly, it's a dense, challenging read. Soros is writing as a philosopher first and an investor second. His goal is to lay out his grand theory of everything for social systems, which he calls reflexivity. And finance, he argues, is the perfect laboratory to test this theory because everything is quantified in prices. So, what on earth is reflexivity? Let's try a simple analogy. Imagine you're at a party. The standard economic view would be that you observe the party's vibe, the music, the number of people, and you react to it. You are an independent observer. Soros says that's nonsense. At a party, your actions, whether you start dancing on a table or stand awkwardly in a corner, change the vibe of the party itself. Your perception of the party influences your actions, and your actions, in turn, influence the party. It's a two-way feedback loop. That, in a nutshell, is reflexivity. Soros breaks this down into 2 functions. The first is the cognitive function. This is you trying to understand the situation. In markets, this is the investor trying to figure out a company's true value, its fundamentals. The second is the participating or manipulative function. This is you acting on your beliefs. In markets, this is the investor buying or selling a stock based on their analysis. In traditional economics, these two are separate. You analyze, then you act. But Soros says they are tangled together in a feedback loop. This idea directly attacks the cornerstone of modern financial theory, the efficient market hypothesis. The EMH claims that market prices reflect all available information. It pictures investors as rational scientists, coolly observing data and arriving at a correct price. The price is a passive reflection of the underlying reality, or fundamentals. Soros argues that this is fundamentally wrong. Investors aren't just scientists observing particles under a microscope. Their observations don't change the particles. Investors are more like people in a relationship. Your beliefs about your partner affect how you treat them, and how you treat them affects who they become, which in turn affects your beliefs about them. The market is a relationship, not a physics experiment. Your beliefs as an investor don't just reflect reality, they help create it. The alchemy in the title refers to this almost magical process where belief can transform the fundamentals. It's not about turning lead into gold, but about turning a widespread belief into cold, hard cash and real-world economic changes. This is a radical departure from thinking of prices as simply reflecting a pre-existing reality. Prices are an active ingredient in the reality they are supposed to be reflecting. So how does this play out in the real world? The most powerful application of reflexivity is Soros's model for boom-bust cycles. These aren't random manias. They follow a predictable, though not perfectly timed, pattern. It all starts with a prevailing trend and a misconception about that trend. Let's say a new technology emerges, like the internet in the late 1990s. The underlying trend is real. The internet is genuinely transformative. Then comes the misconception. Investors don't just see it as a good trend. They start to believe it's a new paradigm where old rules of valuation no longer apply. This flawed belief, this bias, begins to drive their behavior. They pour money into any company with a .com at the end of its name, regardless of whether it actually has a viable business model or any profits. This is where the reflexive feedback loop kicks into high gear. The flood of investment money pushes stock prices into the stratosphere. These soaring stock prices then start to positively affect the fundamentals. A company with a crazy high stock price can issue new shares and raise billions in cash for almost nothing. They can use that cash to buy up competitors, hire the best talent, and run splashy Super Bowl ads. The belief that the company is valuable allows it to become more valuable. The perception is shaping the reality. This becomes a self-reinforcing process. Rising prices seem to confirm the initial misconception, which attracts even more believers. These new investors pile in, pushing prices even higher, which further improves the fundamentals. The media breathlessly reports on teenage millionaires and the new economy. For a time, the believers look like geniuses. The gap between the soaring perception and the more modest reality gets wider and wider. But as long as the upward momentum continues, nobody seems to care. This is the boom. But reality has a way of asserting itself. The trend becomes increasingly dependent on the ever more inflated belief. At some point, the gap between perception and reality becomes too stretched to sustain. This is the test phase. Maybe a key company misses its earnings forecast, or interest rates rise, making it harder to get cheap money. A moment of truth arrives. Then comes the twilight period. The smart money, the insiders who see the writing on the wall, start to quietly sell their positions. The upward momentum stalls. The stock price, which used to go up every day, now just bounces around. The faith of the believers begins to waver. They start to question the narrative for the first time. Doubt creeps in. And then comes the crash. The self-reinforcing process dramatically shifts into reverse. A few people selling becomes a stampede for the exits. Falling prices now negatively impact the fundamentals. The company can no longer raise cash by issuing stock. It has to cancel expansion plans and lay off employees. The media, which once celebrated the boom, now writes terrifying stories about the collapse. Panic feeds on itself. The perception of failure helps create the reality of failure. This downward spiral is the bust. This boom-bust model isn't just a theory. It's a map Soros used to navigate some of the most turbulent markets in history. Let's look at his most legendary trade, the breaking of the Bank of England in 1992. This is a perfect case study of reflexivity in action on a global scale. Stick with me, because the details are fascinating. In the early 1990s, the United Kingdom had its currency, the pound sterling, pegged to a basket of European currencies in something called the exchange rate mechanism, or ERM. Think of it as a club where all members promise to keep their currency values within a very tight band of each other. primarily against the most powerful currency, the German Deutschmark. The goal was to create currency stability in Europe. Here's the problem. The promise to keep the pound's value high was a political one, not an economic one. At the time, the UK economy was struggling with a recession. Standard procedure for a recession is to cut interest rates to encourage borrowing and spending. But to keep the pound's value high within the ERM, the UK was forced to keep its interest rates punishingly high, which was choking its own economy. It was like trying to put out a fire and turn up the heat at the same time. Meanwhile, Germany had just reunified. It was spending enormous sums to integrate East Germany, which was causing inflation. To fight its own inflation, Germany's central bank, the Bundesbank, needed to keep its interest rates very high. Because the Deutschmark was the anchor of the ERM, this forced the UK to keep its rates high too, even though its economy desperately needed the opposite. It was an unsustainable situation. Soros didn't need a complex computer model to see this. He saw the fundamental contradiction. He identified the prevailing misconception, the market's belief that the UK government's political commitment to the ERM was an unshakable fact. Soros's hypothesis was that this political will was in fact very fragile and would eventually break under overwhelming economic and market pressure. The UK government was making a promise it couldn't afford to keep. So he began to act on his participating function. Through his quantum fund, he started to build a massive short position against the British pound. This means he was essentially borrowing pounds and immediately selling them, hoping to buy them back later at a much lower price and pocket the difference. He was betting on the pound to fall, and he was betting big, eventually building a position worth around $10 billion. This is where the reflexive loop started to spin. As Soros and other like-minded speculators sold billions of pounds, they created immense downward pressure on the currency. To honor its ERM promise, the Bank of England was forced to step in and do the opposite, buy the pounds that Soros was selling. To do this, it had to spend its valuable reserves of foreign currencies like the Deutschmark. The market saw this happening. Traders could see the Bank of England's reserves bleeding away. The media started reporting on the immense pressure. The market's perception that the pound was overvalued and the UK's position was untenable was being reinforced by the selling, which was forcing the Bank of England to take actions that made it look weaker and weaker. The belief was shaping the reality. The more the Bank of England defended the pound, the more it proved to speculators that it was vulnerable. The climax came on September 16, 1992, a day now known as Black Wednesday. The Bank of England made a last-ditch effort. It raised interest rates from 10% to 12%, and then promised to raise them to 15%, a devastating level for an economy already in recession. It was a desperate attempt to signal its commitment. But the market called its bluff. The selling was relentless. By the evening, the British government conceded defeat. They announced the UK would be leaving the ERM and would let the pound's value float, meaning its price would be determined by the market, not by government promises. The pound immediately plunged in value. Soros's bet paid off spectacularly. He closed his short position, buying back the pounds at their new, much lower price. His fund made a profit of over $1 billion in a single day. What's crucial to understand is that Soros didn't just correctly predict that the pound would fall. His actions and the actions of those who followed him were an integral part of what caused the fall. He identified a disequilibrium, and his participation in the market pushed it towards the breaking point. This is the ultimate example of the participating function influencing the outcome. He wasn't just reading the news, He was making the news. This story perfectly illustrates another core tenet of Soros's philosophy, borrowed from his mentor Karl Popper: fallibility. This is the simple but profound idea that our understanding of the world is always partial, biased, and potentially wrong. All of our knowledge is provisional, a hypothesis waiting to be disproven. There are no absolute truths in complex systems like human society or financial markets. For an investor, this is a revolutionary idea. Most investors are obsessed with being right. They search for data that confirms their beliefs. Soros does the opposite. He starts with a hypothesis. For example, the UK's membership in the ERM is unsustainable, and then he ruthlessly tests it. But more importantly, he is constantly looking for what might prove his hypothesis wrong. He embraces the fact that he could be, and often is, wrong. This sounds philosophical, but it has a very practical consequence for risk management. He once said, "It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong." Because he accepts his own fallibility, he knows that any trade could go against him. So, when he enters a trade, he isn't just thinking about the potential profit. He is obsessed with his pain point, the price at which he will admit he was wrong and exit the trade to cut his losses. Think of it like being a detective. A bad detective finds a suspect and then only looks for clues that prove their guilt, ignoring anything that suggests their innocence. A good detective, a fallible detective, has a primary suspect but is actively looking for evidence that could exonerate them, because their goal is to find the truth, not just to be right about their initial hunch. Soros invests like that good detective, always questioning his own case. This is why, despite his reputation for huge, risky bets, his actual track record is one of incredible longevity. He survived and thrived for decades because when he was wrong, he got out quick and the loss was small. But when he was right and he saw a reflexive, self-reinforcing opportunity, he would bet the farm and the payoff would be enormous, more than covering all his small losses. Let's apply this to another massive event, the 2008 global financial crisis. The boom was built on the US housing market. The underlying trend was that homeownership is good and home prices generally go up. The misconception was that home prices could never go down on a national level. This belief was enshrined in the risk models of the world's biggest banks. This created a reflexive loop. The belief that housing was a risk-free asset led banks to lend money to almost anyone through what became known as subprime mortgages. This easy credit allowed more people to buy houses, which pushed house prices up. The rising prices proved that the loans were safe, which encouraged even more reckless lending. Financial engineers bundled these risky mortgages into complex securities called CDOs, which credit rating agencies, infected by the same misconception, stamped with AAA ratings, declaring them as safe as government bonds. The belief that housing was safe created a reality where trillions of dollars flowed into the system, pushing prices to absurd levels. The boom was in full swing. But, of course, the underlying reality that many borrowers couldn't actually afford their homes eventually began to assert itself. As interest rates on these adjustable rate mortgages reset higher, defaults began to tick up. The bust began. As defaults rose, banks foreclosed on homes, putting more houses on the market for sale. This increased supply caused prices to level off and then start to fall. Falling prices meant that many homeowners now owed more on their mortgage than their house was worth, giving them an incentive to simply walk away and default. This led to more foreclosures, which pushed prices down even further. The virtuous cycle became a death spiral. The belief in safe housing collapsed, and it took the entire global financial system down with it. It was a perfect, devastating example of a reflexive boom and bust. So, after all this, what are the practical takeaways for an average person trying to invest their money? This book isn't going to give you a stock screener or tell you what PE ratio to look for. Its lessons are much deeper and more about how to think. First, and most importantly, banish the idea that the market is always right. Prices are not sacred. They are the product of a messy, emotional, and often irrational crowd of human beings. They can be, and frequently are, wrong. This means that if you do your homework, you can find situations where the market's perception is wildly different from the underlying reality. That gap is where opportunity lives. Second, pay attention to sentiment and narratives. When you hear everyone, your taxi driver, your barber, the news anchors, talking euphorically about a certain asset, whether it's a stock, crypto, or real estate, a warning bell should go off in your head. That is the sound of a reflexive boom potentially nearing its peak. Conversely, when there is blood in the streets, when everyone is terrified and selling indiscriminately, that is often the moment of maximum opportunity for those who can keep their heads. Third, embrace your own fallibility. You are going to make mistakes. You will buy stocks that go down. The goal is not to be a perfect predictor. The goal is to have a system. For every investment you make, you should be able to clearly state your hypothesis. Why do you think this asset will go up? Then, and this is the most critical part, define what will prove you wrong. At what point will you cut your losses and admit your hypothesis was flawed? This isn't weakness. It's the highest form of intellectual honesty and the key to long-term survival. Finally, start training yourself to look for reflexive feedback loops in the wild. When you analyze a company, don't just look at its current financials. Ask yourself, how is the market's perception of this company affecting its business? For a company like Tesla, the sky-high stock price wasn't just a result of its success, it was a cause of it. It allowed them to raise cheap capital, build factories, and create an aura of invincibility that attracted top talent and loyal customers. That is reflexivity in action. In the end, The Alchemy of Finance is less a book about finance and more a manual for thinking about complex, adaptive systems. Its lessons apply as much to politics, social trends, and even our personal lives as they do to the stock market. It teaches us that reality isn't a fixed external thing that we simply observe. We are participants. And our beliefs and actions, for better or for worse, help create the world we live in. Understanding that loop, that tangled dance between perception and reality, is the first step toward becoming a much wiser and potentially a much wealthier investor.